Thank you for joining today's webinar entitled FDCPA Update, New Risks and Opportunities in Collections. I'm Diana Banks, Vice President with the American Bankers Association, and I'm very pleased to be co-presenting today with Walker White, CEO of Oliver Technology Corporation. Walker, if you would, just please say hello and give a little bit of background on Oliver, please.
Thank you, Diana, and we really do appreciate the opportunity to share the stage here today with ABA for this webinar. For those of you who don't know us, Oliver transforms legal servicing by enabling parties to collaborate on a product that really drives efficiency, creates transparency, and ultimately ensures compliance. Our offering, called Oliver Collections Litigation Exchange, automates and orchestrates all the repetitive regulatory and legal processes to drive more revenue, ensure rigorous compliance, and simplify high-volume litigation. I'll dig into our offering a little bit later, so let me hand it back to you, Diana.
Sure, thank you. So our agenda for today covers two main areas. The first two sections of the webinar are going to cover compliance. I'll be talking about the CFPB's new Fair Debt Collection Practices Act rule, an overview of what to expect in that rulemaking and why it's important to start preparing for it now. And then Walker will share how to bake those compliance rules into your collections litigation system to expedite the process and maintain rigorous compliance standards. The next section of the webinar will focus on the full scope of collections litigation today and for the future. We'll be talking a little bit about the current economic impact on collections and the need for creditors to cut costs and increase effectiveness in situations that have been really exacerbated by COVID. So I'll start that conversation by giving an overview on that economic impact, and then Walker will discuss how to conquer the 5 failure points in collections litigation so that you can understand where you're leaking value in your litigation strategy, how to fix those failures that are causing leaks, and what you need to do now to quickly capture more revenue when the time is right. So let's go ahead and get started. Next slide, please. So let's talk a little bit about the CFPB's impact on the collections market and collection strategy. So we'll be seeing collectors move toward contacting consumers via email and via text versus calling them or sending them letters. Prior to this, obviously emails and texts have been around for a long time, but because of the litigation threat and the private right of action, or the FDCPA, many collectors have hesitated to use email or text until there was a more sturdy legal framework for doing so. And that's been to the detriment of the overall market, because there are many indications that consumers actually prefer these channels for contact. The next thing to note is that creditors really need to be mindful of the oversight requirements for their collection agency partners, and that's why they need to be focused on this rule and focused on how it's going to change that relationship. Collectors are going to be seeking more information that will help them comply with the rule, and they'll be coming back to their creditor partners to get that information. So things like good and bad phone numbers, email addresses, whether a consumer has opted out of communication, information that's needed for validation notices, all that kind of data. Those are things that collectors will now be asking their creditor partners to provide, and that's a shift in what we've seen previously and something that creditors definitely need to be preparing for now. Additionally, in the rules proposal, the CFPB was planning to use their UDAP authority under the Dodd-Frank Act to issue some of the rule provisions. That then raised questions about the ability of state attorneys generals to then enforce the rule especially against national banks, and whether those provisions of the rule would end up being applicable to creditors. So we're very hopeful, we being ABA are very hopeful that the Bureau will decline to use that UDAP basis, that they'll instead use the statutory authority under the FDCPA to extend the rule, which would make it clear that the rule does not itself apply to first parties. And so keep in mind that the COVID crisis has really brought these collections issues to top of mind for many state legislatures and including Congress. The distinction between first and third party is in some cases not as clear to consumers as it was when the FDCPA is written. So we can expect, even after this rule is issued, that there'll be further probably legislative action on the FDCPA and on debt collection. So with the compliance issues being so high on the radar screen these days, let me turn it back to Walker to talk a little bit more about how you can bake compliance into your collections litigation strategy.
Great, thank you very much, Diana. I appreciate the input on the FDCPA rules and what's coming down from CFPB. I know it's top of mind for many of the creditors that we're working with. So we actually just heard yesterday from industry experts that collections litigation as a channel, as a result of this ruling, may well see kind of its heyday coming out. As Diana just expressed, the new rulings from the CFPB will really curtail some of the most widely used and frankly, unfortunately, often abused practices in collections as a direct calling and so on, and move to these more digital channels. And while collections litigation may seem like a huge escalation, it actually provides a number of very real benefits to the consumer. First, it introduces a disinterested third party into the situation, which is, of course, the judge and the law. Second, the civil processes are institutionalized. Both the creditor and consumer know exactly what to expect. It's basically a train that's running down a track. And finally, one of the other benefits of litigation is that being institutionalized, it reduces variability, which I think is a lot of what the FDCPA and CFPB are trying to put their hands around. It reduces the variability, which is much better for the creditors because it allows them to control the compliance and reputational risks of trying to recover debt from consumers. And even if creditors are not directly interested in pursuing litigation, they're likely to want to ensure that their partners or parties or those who are collecting on debts of their customers are following these rules and maintaining rigorous compliance. But as Diana pointed out, this comes with its own challenges, and they are specifically around compliance. So let's dig into that. And primarily, the biggest failure that we deal with when it relates to collections litigation is how do we effectively maintain rigorous compliance with all the federal, state, local, and often even venue-specific laws, rules, and procedures that need to be followed. And since the formation of the CFPB, from a creditor's perspective, the amount of quality control checks and audit requirements that are required have just grown exponentially. And currently, there's really no easy fix. Either the creditors or their partners need to hire more people, or you simply need to reduce the volume. In the face of what we're expecting to see as a result of the current economic environment over the next few years, neither of those courses of action really seems like a great fix. So what I'd like to do is just talk a little bit about what we believe the fixes are to that, to allow a creditor to maintain rigorous compliance and still be able to collect on those things. And they really fall in these three categories of built-in compliance, simplifying audit, and customization, which I'll talk about in just a moment. So if we break each of one of those down, first, built-in compliance. Technology today, a lot of the collections litigation technology that exists today was literally built in the 80s to be used in the 90s, and there's just so much more technology available to us today. And a good example of this is TurboTax. We can, a regular person like myself, even though the tax laws is hundreds of thousands of pages, we can go onto a simple tool, TurboTax, and file our taxes and remain compliant with the IRS. And there's no reason that we can't do the exact same thing in collections litigation. Yes, there are 50 states, and yes, there are federal laws and rules, procedures, and so on, but we can codify that information today. Technology can codify that to ensure that all those federal, state, local, and venue-specific laws, rules, and procedures get followed. Additionally, we have to have extensible procedures to maintain compliance. That there are very specific actions that a creditor, the creditor may be under the law able to do something, but for reputational reasons or their own internal controls, they may not want to do something like that. So it's not just about being rigorous to what exactly we can do, but also being able to put those procedures in there, allow us of what we want to do. And then finally, from a compliance standpoint, we want to make sure that we are reporting on things on an exception basis. with the amount of charge-offs that are available today and likely to be in the future, trying to observe each one of these is not going to be manageable, but rather to get granular visibility and agility to manage outliers. So cases of true hardship or cases of certain types of venues or specific jurisdictions or whatever it might be, allow us to manage these things on an exception basis. The second area is really an audit, and this again goes back to the point of the CFPB and what's being trying to accomplish there is making sure that the creditors and folks that are doing this are staying in compliance with all the rules and procedures. But just doing that, trying to keep track of all that, is exceedingly difficult. So there are three things that we can really do to help that out. Automation, make sure we have good accuracy and provide end-to-end visibility. From an automation standpoint, we want to make sure in a collections litigation strategy that we're literally capturing every step that's occurring, and perhaps most importantly, what is known as attorney meaningful involvement, which is when is an attorney actually looking at a matter, how much time are they spending on it, is it a meaningful amount of time, and from a creditor standpoint to stay compliant, they need to be able to measure that. The second thing we want to be able to measure clearly is, with accuracy, is the handoffs and reviews and approvals. Are you following the documented processes and procedures that the creditor has in place and that are required by various state and federal laws? And again, being able to audit that and be able to see every step along the way is critical. And then finally is visibility, which is at the end of the day, we want to be able to look from a creditor's viewpoint at all of the matters that we might be trying to collect on and ensure that they are meeting all of both our internal controls, the laws and procedures that exist out, and so on. Finally is the area of customization, which is to say that litigation is an art form. There's science to it, but there's also art form to it as well. And within the guidelines of a given compliance framework, if you're going to sue a matter in a specific county in a specific state, there are many ways to do that and remain compliant. So we want to make sure that the standard operating procedures that a bank, that the creditor, or potentially their partner law firms who are doing this on their behalf have the flexibility to kind of navigate within those guardrails, if you will, of the compliance framework. And then the last thing is just agility. The technology today enables us to adapt much more quickly to changing market and regulatory conditions. For example, the COVID pandemic is a great example where all of a sudden a bank or creditor wants to stop entirely what they're working on, and before they restart, they want to send out, a courtesy letter to make sure that, hey, if you've got a real hardship, let us know because we can stop this process. And that's a good way for the creditors to kind of maintain compliance, adapt with the market conditions, and also manage their reputational risk as in the environment. So with that as a backdrop, I am going to hand it back over to Diane right now to really talk about the impact, the current economic impact on this collections market and what it might mean to us, going forward. So Diana, back over to you.
Thanks, Walker. So the collections market is currently experiencing the first full credit cycle in the CFPB era. In February of 2020, according to the St. Louis Federal Reserve, consumers were expected to default on at least 2.3% of outstanding debt, which would cost creditors over $325 billion. However, that prediction was prior to the impact of the pandemic. So if the 2008 and 2009 recession is any indicator, we should expect to see defaults almost double. And many feel that we're definitely heading in that direction. Next slide, please. So the government and creditor programs have been put in place to help mitigate the impact of the pandemic shutdown, but many of those initiatives have ended, and future initiatives for stimulus are now in flux. So as we all remember, in the spring, the economy shut down, so people were not spending at the same rate. And then according to the US Commerce Department, the expiration of the $600 a week federal supplement to unemployment benefits was then followed by a 2.7% drop in personal income in August of this year. And while the CARES Act and PPP helped small businesses keep employees for a while, we're now seeing the full impact of the pandemic shutdown, with 1 in 5 small businesses closing for good. Large companies have not been immune either. Many have announced large layoffs, particularly in the travel and entertainment industries. Disney cut 28,000 jobs, airlines have cut over 60,000 jobs, and so on and so forth. Everyone is definitely feeling the economic impact that the pandemic is having. And so while creditors have been helping with initiatives like mortgage loan forbearance and not filing people as delinquent, we can't expect for those types of initiatives to go on forever. So as a result, our current debt numbers are kind of skewed. There's definitely a delayed reaction. And so while we saw an initial dip in delinquencies, the real impact is likely to be substantially higher. Next slide, please. And history shows that delinquencies will rise with recessions. However, 2020 is a crazy year, and that's an understatement. And we're really seeing that delayed reaction playing out right now. So in fact, delinquencies have been declining since consumers were spending less money as well as receiving stimulus. Many of them use that opportunity to reduce their debts. So as you can see on this chart, which plots delinquencies in red against unemployment numbers in blue, that effect is seen pretty clearly. However, industry experts are anticipating that this is not going to continue and that we should expect a significant increase in the coming quarters as we really start to feel the full effects of the pandemic. And so creditors are now looking at what they need to do today to prepare for an inevitable influx of debt collection in the near future. Now I'll turn it back to Walker, who's going to share some thoughts about how you can navigate through these challenges today and start preparing for that future that's coming very soon.
Great. Thank you very much, Diana. Again, it's remarkable, what's going on at a macroeconomic level here in the United States. And it's just counterintuitive that, during all of this that, we're actually seeing the delinquencies decrease, but obviously that it can't last forever. So when we, again, I'm going to talk a little bit first about our business, Oliver, and what we do, and then I'm going to talk a little bit about these kind of 5 failure points in collections litigation and how we can help mitigate those with our solution to ensure that customers can, get the revenue they expect, maintain rigorous compliance, and really simplify the process of litigation. So let me just start with a brief overview of our business. What do we do? So Oliver sells a solution called Collections Litigation Exchange, or CLX, and it is a collections litigation platform. It's designed to consolidate and orchestrate all of the repetitive regulatory and legal processes in collections litigation so you can increase revenue, you can maintain rigorous compliance, and ultimately simplify the high volume litigation process that goes on. And we do this through 3 primary work streams: a consolidation of data, an orchestration of activity, and obviously finally the acceleration of the actual litigation activity, and all under the guise of maintaining very, very compliant, very, very thoughtful, and very, very fair collection practices, utilizing this collections channel. So our experience has been that there are really 5 areas where we shed, if you will, value in the collections litigation model and in the collections litigation channel, I should say. And we'll dig into each one of them kind of with the problem statement and kind of what we believe the fixes are, and then we'll wrap up. So let me start by talking about failure 1, which is the data is fractured. We have these kind of antiquated data formats and collection methods, and it's limited across the various parties that need to be involved. So creditors have systems of record that come in many, many forms. And while standards exist for all the data for this, these were literally designed decades ago, and they are not flexible enough to handle the very dynamic environments that we're seeing today, with new rules, new requests popping up all the time. Additionally, due to the number of systems and handoffs, these processes raise the risk of inaccurate or incomplete information, either for the creditor deciding if a particular account is suitworthy, or potentially for their partner law firm acting upon it. And there really is an opportunity to improve in this area and really modernize. And the solution, the fix to this problem is obviously first consolidation, to bring all the data together about the into, if you will, a litigation master record that's visible to all the parties, such that the creditor, the law firms, process servers, appearance counsel, everyone who's involved can be sharing the same sheet of music, if you will. The second thing we do to fix that is to automate many of the data the data challenges that have been solved many times now. More recently, the data challenges of loading information, validating information, cleaning information, transforming information, redacting information such that a creditor doesn't share PII about their consumers with people who don't have a responsibility or a need for it. And finally, in making that data accessible, right, with proper permissions, as I just mentioned before, to be able to share the data and the same data with all the interested parties. This is collections litigation is a process of many parties, including the consumer. They may not want to work together to get to resolution, and we want to make that as quickly as possible, or as seamless as possible, as fair as possible. And the way we do that is by starting with sharing that information. The second problem that often are faced by creditors is the disparate platforms or disparate systems on which this is operating. We have historically gone from a file. If a file wanted to be worked by a creditor, wanted to litigate a matter, they would sell the debt or toss the file over the fence and then kind of lose sight of it until there were payments coming back or not, whatever the case might be. And often matter-specific communication was relegated to separate channels, which is to say, hey, I want to catch up on that particular matter, call the law firm calls back, maybe we send some emails, just not consistently trapping that information, which again invites compliance risk, right? If a creditor wants to stop an activity, be able to see where it is exactly in the process is incredibly valuable. And anytime there's just no master record for information like this, particularly one that has such high impact in PII and compliance risk, you're going to leak value and efficiency from the process. So our solution to that, or the fix to that, is first collaboration, orchestration, and visibility. Collaboration is really not a surprise. We all today utilize platforms that allow us to work in concert with other people, but collections litigation doesn't work that way. It's kind of this game of tennis where the thing is being thrown back and forth across the net. But if you think about platforms where we collaborate all the time, whether it's on LinkedIn or other things, we deal with this every single day, and these are very natural and very modern ways to collaborate between all the parties. The second thing we're able to do with bringing all this together on a single place is to effectively automate the handoffs, the approvals, the reviews, to accelerate the process and capture a standardized audit of the who, what, and when of each of those transfers. So if a creditor and their associated law firm are working on the same file, at any given point in time, that creditor can just say stop, right? And it's not, they literally can prevent it from going forward, and for any reasons that they may choose. And finally, really providing visibility, end-to-end visibility for the creditor to the entire channel to understand exactly which of their consumers are being litigated in the process and how that is progressing. The third area we already touched on, so I won't reiterate, but is really the most important, I think, in this day and age as it relates to, and particularly in the environment that we find ourselves today, which is really around maintaining compliance. The rules, laws, and procedures that we have to follow now to do this in a fair way are voluminous, and they are changing all the time, and they vary by state. So we absolutely need a way to codify that and make sure that we can follow all those rules and laws as we proceed. The fourth area is just in the question of scale. What we expect is, I think as Diana pointed out early on, that we should probably expect defaults to raise by at least 2x coming into probably the second or third quarter of 2021. And we need to be able to deal with that scale in whatever way we choose to go after it. But it's very, very difficult for a creditor to develop a consistent process for dealing with these channels because of the various law firms that they'll have to operate with across all the various states. So again, the fix to that solution is, again, starts with standardization. By having a single platform by which the creditor can be filing these, putting these matters into the market, it allows them to have a consistent process that they manage, that they understand, that operates their standard operating procedures and ensures meets their internal control guidelines. Also from consolidation, again, that's come up again, but bringing their law firm partners into a single platform to share in those processes is very valid. And finally, it gives them the visibility they want, or again, that visibility showing up again, being able to provide that kind of end-to-end sight for the creditor of what is being done and who is touching our consumers. Because as it turns out, even when you litigate things, you often don't lose the consumer as a customer, right? Because again, that process is it's a civil procedure, and it's a very, very civil procedure. It's just very well known and so on. So there's really great value to the creditor for that. And then the last area that we really help out is in the area of what we call stalled inventory, which is when historically collections litigation operates in batches. So you take these 100 files or 100 matters in Ohio, and I'm going to give them to a law firm, and then I'm going to say, okay, great, tell me what you find out from all that. Those days are behind us now. We have the ability to really create actionable views on information. So not being able to kind of treat our consumers as a bucket, basically, but being able to deal with our customers on an individual basis, being able to have actionable views to see what is happening with a specific file rather than a tranche of files that we've sent out to there. And that gives us granularity, right? It gives us granularity into understanding, the various hardships that an individual might have rather than looking at these things at a top level. And then finally, again, making his third appearance is visibility. And I think that this process, the collections litigation process, particularly from a creditor, one of the greatest risks has always been that there's no transparency in it. They lose control of their consumers and their customers. And with visibility and with the sharing that we can provide with a solution like this, it just opens up, it just is much more valuable to the creditor. They keep track of everything that's going on in their environment. So with that as a backdrop, let me just close today and note that we held a webinar recently with one of our customers, U.S. Bank, and then it was Heidi Stallo, who is the Vice President, Assistant General Counsel at U.S. Bank. She was paired up with Stephanie Jackman, who is a partner at Ballard Spahr. Ballard Spahr, one of the leaders in collections litigation and the CFPB and the FDCPA rulings and so on, a real industry luminary in this space. And we talked through these with a lot more detail from a legal perspective and from a creditor's perspective, how you can address these five failures in collections litigation. And I encourage you to visit our, olivertechnology.com/webinars, and you will be able to hear from both industry experts and customers about how they were able to kind of navigate through this pandemic and prepare for what's likely coming tomorrow. So with that, I guess we'll close. Diana, I want to thank you again for your time here today and for bringing ABA into this. And that's it from my end.
Thanks, Walker, and thanks to all of you for joining us today. And we hope that you'll stay in touch with ABA.com.